All right, everybody. Hey, good morning. Thank you all for being here. Really excited about having everybody, seeing lots of great faces. As you know, I'm Mark Mangum with Eltekon, of course. There's Brent Beasley, one of our other principals in the firm. Brent. Louis Gilbo, one of our advisors as well, and Miss Lisa Triolo. You probably all checked in with her. Couldn't be more excited about today's event. As many of you know, we've got three speakers today. We're going to be starting out with Dr. Miller from Black Creek Group. We'll mention him in just a second. Then we'll break for lunch, and then we'll have Bob Stein, who is an economist out of Chicago with First Trust, one of our partners. He'll be coming from 11:30 to 12, talking about just overall markets and market conditions. And then we'll finish it up with Vita Capital, an alternative investment manager here in Austin that's doing some creative things from a performance perspective. Thank you all. I know that time is important to you all, and so thanks for being here. In November, Louis and I went to a conference. Brent's gone to it before, but I went to a conference in Denver with Black Creek Group, and heard Dr. Miller speak, and he spoke on the real estate markets as a whole. There was 200 advisors in the room, and he also talked a little bit about some e-commerce and the impact on real estate that e-commerce is having. And then he also mentioned stuff about the Austin market, which of course we're in, and he referenced some other markets as well. Because we do, by the way, have people that have flown in today from Florida and Carolina to hear our speakers today. And so I thought, man, how great would it be to have Dr. Miller here to share with those of us who, many of us have a real estate interest, whether it's professionally or as investors, as holders. Wouldn't it be great to have Dr. Miller here? So without further ado, I'm going to pass it on to him. Really excited about Doc being here. He's currently a University of Denver professor. He works with Black Creek Group. He's been a guest professor at the University of Harvard. He has a long, extensive history, and his bio is right here. Doc, thanks for being here. Appreciate you being here.
Thanks. Yeah. So now 42 years in the real estate industry, which means I'm really old, right? And I've been doing research. I was a builder in my young career, worked at a bank, and I've worked for a lot of different companies. And what I want to do today is talk to you about real estate. And I want to start with the fact that there's really two different things in real estate. So take your mind and think about this. There is home ownership. I'm sure you all own at least one, if not two, maybe even three houses, right? And to invest in that is literally only one thing. It's just like cars. It's a production process. You take raw land, sticks and bricks, put it together, you build houses, and you don't make any money until you sell it. When you sell it, it's done, and all you do is have a warranty that you got to take care of, pretty much like a car, okay? The other part of real estate, which I'm going to talk about today, is income producing real estate. Notice that I didn't use the term commercial, because I'm using income because there's actually 5 major property types. We call office, industrial, and retail commercial, but most people don't think about apartments or hotels as commercial. So that's why I use the term income producing. So we've got these 5 major food groups that I analyze, that we look at as we go along. And the easy way to think about it is real estate's just a delayed mirror of the economy. If the economy is doing well, real estate's doing well, okay? And as a professor, I got to ask questions and, kind of quiz you on things, okay? So first question is, how many people are there in the United States today? What's our population? Anybody have a? 400. Well, I got 400. 325. I got 325. 330. 330. Well, here at 335. You're here at 335. How about 330? 336 million right now. That's the official number. Of course, that doesn't, we have no idea about illegal immigration, et cetera. We're growing at 0.9% of 1% a year, or about 3 million people a year, okay? And let me put that into real estate terms for you. That means that we need to build a city the size of Denver, Colorado, which is just about to hit 3 million people, to give them a place to eat, sleep, shop, work, play, pray, okay? So every time we have more people, we need space for them. And so that's a good thing. We continue to build. When I went to school in Denver in the early 70s, I was there when the population hit 1 million. We're about to hit 3. And of course, we have bad traffic problems, et cetera, just like you do here. So growth is good, but growth is also can be a problem, right? Next thing is GDP growth. GDP growth is basically gross domestic product. It's the output of the country. It's like thinking about any company and what they're producing, et cetera. And you can see that during the Great Recession of 2009, GDP goes negative, and that's a definition of a recession is 3 or more quarters of negative GDP growth. Since then, we've been growing at a rate of around 2%, and that's projected to continue. And this is actually an older projection where it comes down. This morning, GDP for the fourth quarter of 2017 just came out from, the Bureau of Labor Statistics. Anybody know what it was? 3%. I got 3. I got 2.1. 2.8 or 2.6. I got 2.4. 4% total? No. That would be huge. That would be amazing, right? It was 2.6%. Okay. And the projections now that the new tax laws have passed is that obviously that's going to ramp up, and most economists are saying 3 or more. If we look back 20 or 30 years ago, we were seeing in some cases 3 to 4% GDP growth. The problem is when you have a really high GDP growth, you have a boom bust cycle, and that obviously makes life a little more difficult for investing and everything else. So I like this lower for longer kind of thing. We'll see what the economists that come up later say. And I'm not an economist. My PhD is actually in real estate, but I take and I interpret economic information for what it does to real estate. The number one driver of demand for real estate is actually employment growth. Every time you employ someone, they need a place to work, okay? And it could be in office, industrial, retail, and they obviously come out of school and they rent an apartment for a while before they can buy a house. So you can see employment growth has been running around 2%, and you see it starting to slow down. And the reason for that slowdown in growth or deceleration, it's not negative, is that we're going to have more baby boomers like me retiring than we have millennials, coming into the workforce. So the workforce is actually going to go up, but it's going to go up at a little bit of a slower growth rate as we go along. Right now, we got a lot of millennials for the next 5 years coming out of school, getting their first job. And just like for me in the 70s, that created a great boom period in the overall economy. So that's kind of the demand side of real estate looks good, okay? The other thing that we look at is the cost of operating any company, any real estate, or whatever the case may be. And the key things are inflation. And inflation, go back 30 or 40 years ago, we had inflation in the 80s and the teens, right? So your dollar Coca-Cola with a 12% inflation cost $1.12 the following year. Inflation has come down and has been kind of bouncing around in the 2% range. Forecast here that it's going to go up to the 3 or 4% range because they keep saying we're going to have wage growth, and then we don't have wage growth. Anybody kind of know why that is? Well, it's this simple. Let's just take a baby boomer who's retiring, who's making over a 6-figure income, over $100,000. Is a new millennial who's getting hired getting that same salary? No. They're coming in at 50, 60, whatever it is, kind of half. So the average wage isn't changing because the new people being hired at a lower rate than the people that are leaving, okay? And that's one of the reasons that we haven't had, I think, a lot of inflation. That's good news for us in real estate because operating the property, the cost of operating the property is not going up a lot. The other thing are interest rates, and we care about 2 interest rates here. LIBOR, which is the London Interbank Offer Rate. It's the international number that is used when banks lend to each other. It's used for short-term loans like construction loans, okay? And that rate has been bouncing around literally in the 1.5% range. It closed at 1.65 yesterday. And so the cost to get money to build new is very, very low historically. The 10-year Treasury, on the other hand, has been running, and that's the benchmark everybody uses for the risk-free rate. You've got a house, you can go out and get a 30-year mortgage today at probably around 4%, right? Income-producing real estate, they don't give us 30-year mortgages. The maximum length time is 10 years, okay? So we benchmark to the 10-year Treasury. The 10-year Treasury has been running in the 2% range for the last 7 years. And every year, every economist says it's going up next year, it's going up next year, it's going up next year. Just had a friend in to speak to my class from a major national company, and he went, for the 7th time in a row, it's going up next year, right? Will it? We don't know. It closed at 2.65 yesterday. So very low interest rates, and so we can borrow at, let's say, 10-year treasuries plus 1.5%, or right now, we can get a permanent 10-year loan at 4%. So a very, very low interest rate. Go back to the 1980s, and we were talking 15% mortgage loans. So the cost of owning and operating and financing real estate is actually very good today. So we're kind of in a sweet spot from that standpoint. President is in Davos right now talking to all these international companies. The US is the biggest gorilla on the planet. Our GDP is 26% of all the countries in the world. The World Bank covers 217 different countries. These top 15 here make up 73% of the world's GDP. Okay, so they're the ones to watch. And if you look at that, there's only 2 of us that are over 10%, right? And how are those countries doing? Well, they're growing, and growing at, again, moderate rates. So this is the first time, listening to the news this morning, they said this is the first time that we've seen basically every country, every major country in the world, all having GDP growth that's aligned. We don't have a country that's tanking. So we're in a unique and amazing time right now across the world.
Can I ask a question on that?
Sure.
Do you know what, say, 5 years back, how the U.S.-China numbers would have looked?
Yes. The U.S. would have been slightly higher, and China would have been, I think it's been kind of, as it's moving up in its GDP each year, in terms of dollars, it was like it's kind of risen from 10 to 15 over the past 5 years. Great question, thanks. Okay, so yeah, and 5 years ago, people were predicting, because of the way China was growing, that by 2020 it would surpass the United States, but it has now slowed down. They used to be getting GDP growth of like 10, 12%. Now they're down to, I think, 7 forecast for this coming year, so kind of half of where they were, because their government was just stimulating stuff to make stuff happen. Funny thing, they actually built some cities that there are no people in. So they went out and constructed all kinds of high-rise apartment buildings and offices and and then the people didn't come in. But China, if you think about it, China is going through what the United States went through in the early 1900s. We were basically an agricultural country that became industrialized, and now we moved to technology. China was, 10 years ago, was pretty much agricultural. All the people were living, out on farms and stuff like that, and they've been moving into cities and industrializing. Of course, their biggest problem is they're creating huge pollution that they're now trying to overcome. So, one of my favorite charts is, what does everybody care about when you're making investments? Give me some yield, give me some income, right? And a couple of years ago when I turned 60, my retirement money at the university has to be with TIAA-CREF, Teachers Insurance and Annuity Association College Equity Retirement Fund. Okay, TIAA-CREF is actually the largest public retirement fund in the United States today. Okay, or I should say non-governmental. The largest public retirement fund in the country is CalPERS, California Public Employees Retirement System. CalSTRS, the state teachers, is the second. Texas State Teachers ranks 14th, I think, in the country as far as retirement money. And so we call them institutional investors. So we have pension funds and endowments, okay? And the largest endowment in the country, anybody know? Well, it's a university. Harvard has the largest endowment, and I believe it's $36 billion today, okay? So, turning 60, I get a call from TIAA-CREF, Dr. Miller, you have never sat down with a financial advisor before. We'd really like to talk to you. I go, I got a PhD, I know what I'm doing. He says, oh, come on. So, sit down with this young guy who happens to be a year younger than my oldest son. He goes, Dr. Miller, as you turn 60, we really recommend you go into more fixed income. So we'd like to see you maybe, go to a bond allocation of about 60% in your portfolio. And I said, really? And I always have my computer, and I pulled up this chart. And I said, because this is what my son calls all his friends, I said, dude. I said, dude, let me show you the history of interest rates since I was born. I said, the average yield on the 10-year Treasury over the past 60 years has been about 6%. I said, and you've got some math here, right? When interest rates go down, what happens to the value of a bond? It goes up, right? And when interest rates go up, the value of the bond goes down, correct? He said, yep. I said, now, there's some dude or dudette back at the home office who has run a model, and they typically go back and they use 30 years worth of history to kind of figure out what's going to happen in the next 30 years. Is that right? And he goes, yep, that's right. We look at 30 years worth of stock market returns. And I said, so here we are, 1981, we hit the peak, the highest rate of the 10-year Treasury at 15%, and inflation was running at the same rate. Since then, interest rates have bounced around a little bit, but they basically consistently come down over the past historic 30 years. And as interest rates go down, the bond values go up. So the total return, while the yield, the cash on cash coupon that I'm getting, has averaged 5.9, the total returns on bond from 1981 through 2017, 8.4%. So if you're putting that into your allocation model, yeah, you're going to want me to buy a lot of bonds. I said, but right now a 10-year Treasury has a rate of 2.2% back then. I said, and so it's here. It's not here. Hence, I got to look over here and say, what's going to happen over the next 30 years? And the answer is the average total return on bonds going from 2% up to the long-term average in 1973 gave me a return of 1.9. And the average return from here to the peak gave me an average of 3.9. If you plug that number in, what's going to happen? He said, your bond allocation is going to go way down. I said, great. I don't want to invest in something that is pretty well guaranteed that I'm either going to earn that little 2% number, or I buy a muni bond at 4% or whatever, and it's either going to just sit there at that, and if inflation goes above that, I'm losing money in real terms. Or if the interest rates do go up, my principal is going to go down. If I have to sell it before it matures, I'm losing money. He goes, you're right. What are you going to do? I said, well, I'm going to put my money into real estate. TIAA-CREF has a direct real estate fund, so I'm allocated 60% in my personal retirement portfolio from the university in a direct real estate fund. Another reason why we see people, and I'm going to keep referring to institutional investors here, why institutional investors invest in real estate is it's really a different asset class. It's not stocks and it's not bonds, it's different, okay? Size-wise, it makes up close to 20% of the investable universe out there, okay? This is income-producing real estate. If I looked at housing size-wise is about the same as commercial real estate, okay? And what I really recommend that you all do is, as you're looking at your personal wealth portfolio, take your house out. Don't put it in there, you got a really nice house worth $1 million. You live in it, you don't live on it. And if you sell it and you want to replace it and you're going to buy a similar house in a similar location, and nice amenities, et cetera, it's going to cost you the same amount of money. So it's not something you can, hey, I got this big profit, I can sell it and then I can live on it. I guess you could put it into a bond and pay rent someplace, right? But separate that from your investments in which you can live on, which you can get a return from and live on. So it's about 18% of the investable universe. And if you looked at most institutions, they have an allocation somewhere between 5 and 20%. During the Great Recession, the best returning institution was an endowment, happened to be Yale's endowment. Why did they do so well during the Great Recession? They were allocated 33% to real estate. They said, we think there's a crash coming, we're going to put it into a long-term hard asset that we think can survive this downturn, okay? So, how has real estate done? Have you ever seen an index on real estate returns? We've got, the S&P 500 and the Dow and all kinds of other indexes in the stock market. We got bond market indexes, et cetera. Well, all these institutions got together almost 40 years ago and created an organization called NACREF, National Council of Real Estate Investment Fiduciaries. Every pension fund and endowment says, okay, here are the properties I own. They put that information in. I bought it. I paid this for it. To be a member, they have to have the property appraised every 3 years externally and come up with a value every year, et cetera. The average return since starting in 1978 has been 9.2%. Okay, so that's how many economic cycles? 4, right? Inflation over that time has averaged 4.1%, so income producing real estate has a return that has averaged twice the rate of inflation. All the research done academically and professionally shows that research is a great hedge against inflation. Okay? So here's the major recession of 1990, 1991, and that was actually the 80s was a time when we overbuilt buildings a lot. We put up a lot more office space than we needed, and then the Great Recession was the other time frame that we lost
And so
money.
those dropped relative to other forms of investment. So if I'm down 15, 17% in the crash of 09,
Right.
I'm down 7% in 08, what was the loss if you just took the market itself? It cut itself in half.
The stock, well, I think, wasn't the stock market correction in the 40 to 50% range in here?
The NASDAQ was 70% drop
70?
in 2000.
Yeah.
So that the number peak to trough, the S&P was down 53, the Barclay Ag was down 31, and public REITs, we don't talk about securitized real estate was down 77. Think about it.
So anytime something's publicly traded, it's a lot more volatile. Okay? You may have all heard of Roger Ibbotson, the famous professor from University of Chicago. He went and gathered research back to the early 1900s, and one of the things he collected was real estate information. And here, over the past 82 years, you can see years of up and years of down, because a lot of people, a lot of friends, when they say, okay, I want to make an investment, I don't care about hitting a home run and getting a really high return, but I don't want to lose any of my principal, right? I got the money and I don't want to lose. And you can see that the stock and the bond market have both had 20 plus years of downturns, whereas real estate has only had 5, okay? And if we look over the past 20 years, this is a study done by Lipper. Real estate was the 3rd best performing over the last 20 years, with only US small cap and US mid cap doing better. So, everybody thinks that the economy is kind of at a peak. We're talking potential recession soon, et cetera, except that as I look at what is happening, economists every year kind of keep pushing out when the recession is going to happen. And I'm now hearing most economists say, you know, originally 5 years ago it was, we're going to have a recession in 2018. And now they're kind of out to 2022. The new tax laws, I'm now seeing people running their forecast 2023, 2024. So we've got maybe 5 to 6 years of a run, right? And a lot of economists go, wait a minute, in history, we've never seen more than a 10-year expansionary period in the United States. So it can't go longer than that. Why? Why does history have to exactly repeat itself? Anybody, quiz question, know the longest economic expansion in the history of the world? And what country? I'm sorry? Australia, they're in their 26th year of expansion right now. Haven't had a recession in 26 years. So it is possible to have things move forward from that standpoint. So what I did was I said, okay, let's assume that I'm not smart enough, and I'm not, to be able to time the market cycle. But I know when we're at the bottom because we're in a recession, right? So I went and I took the NACREF index returns and I said, okay, let's buy at the bottom of the recession, because I know I'm in a recession, that's the best time to buy, right? But I'm not smart enough to sell at the top. I end up holding to the bottom of the next recession. What happens? Well, 1978 to 1991, my $100 became worth $193. 1992 to 2002, the longest one, my $100 became worth 220. 2003 to 2007, another short cycle, my $100 became worth 2000 or 210, so more than double. And here we are. The Great Recession actually had my $100 drop, and these are quarters, by the way, and come back. So it took about 4 years, 2 years of value going down, 2 years to get it back, and that's where we sit today at $175 on that $100 investment. How long will this go? You tell me when the next recession is, and I'll tell you when real estate's going to turn down. Pretty simple. Okay? So, again, as I said, when we talk about income producing real estate, there's really 5 major property types. And they all move slightly differently. And this will be at least a little bit surprising to you. So taking the NCREIF index, back to its inception, the best performing property types were retail and industrial with a 9.5% rate of return. Oh, and by the way, the return that I'm showing you here is the return on a property with no mortgage on the property, no leverage, no loans at all. The reason they did that was they said, well, if you leveraged a property at 50% and you leveraged a property at 80%, your return on equity is going to be better, right? Because you're getting a loan at a lower rate than the property return. But for an apples to apples comparison, we can see the property itself, we can see its income before paying the debt. So that's a better way to benchmark so that I can tell how an advisor who's running my money is doing. Are they doing better than another advisor? They got a better return just because they leveraged it. That's taking a little more risk. So these are the unleveraged returns, if you will. So retail had the best return. You go, well, wait a minute. Right now, retail is not doing well. Well, the press is all over, places close, people like Macy's are going out of business, et cetera, et cetera. And this is all institutional quality, high class A type properties. And it's made up of 2 major things, major malls, and then a grocery anchored shopping center that has the barbershop, the beauty shop, the liquor store in it. They do well through all types of economic times. As a matter of fact, grocery stores actually do better in an economic recession because people go out to eat less and buy more groceries. Okay? And a grocery store signs a 20-year lease because they have to put a ton of money in with refrigeration to make those work. And today, when Macy's goes out of business or gets out of a mall, the owner of that mall is like, yay! Going, why would he be doing that? Because Macy's, as an anchor, paid the lowest rent of any of the tenants. The little inline guys are paying at least double, if not more, than what Macy's. And what are they redoing with it now? A mall is basically the main street of a suburb, right? And so they're replacing it with more restaurants, more movie theaters, and more experience retail like escape rooms and anything else like that, who are paying at least double the rent that Macy's was paying. So they're like, we're actually going to make more money than less in that mall. Industrial is just a standard stalwart part of the economy. We need more stuff, and we'll get to that in a second. Next is apartments, a little bit lower return. One of the reasons that apartments have always had the highest occupancy level, so they're the most stable of properties from that standpoint. We pay a higher price for them, which means we get a lower yield, and we call that the cap rate. Think of it like the bond yield. So whereas on industrial, I might get a 6% cash on cash return buying the property, on apartments, I'm probably going to buy it at a 5.5 cash on cash, just income return plus its price appreciation. The reason is the federal government actually subsidizes housing overall. So they do that by having Fannie Mae and Freddie Mac. You've probably heard of them, right? So what they do is a bank makes you a loan, they sell it to Fannie Mae or Freddie Mac, they pool them together into a mortgage bond and sell those out into the marketplace with a government guarantee, hence at a lower interest rate. So the interest rates that we get on our homes and apartment developers can get on their apartments is about 1% lower than other income producing real estate loans. Okay, so it's actually sort of a funny thing that the government subsidizes that. During the Great Recession, when we foreclosed on a lot of places and Fannie Mae and Freddie Mac were potentially going to go bankrupt, the government came back in and said, okay, we're going to take over and stabilize the economy by not letting you go bankrupt, and in return, we now own you. Last year, Fannie Mae and Freddie Mac gave our U.S. government a $15 billion dividend. So they took over and stopped a problem, and the government's now making $15 billion a year from Fannie Mae and Freddie Mac, which is pretty good. Office a little lower. Notice that the standard deviation, standard deviation is the volatility in the return. While the average return is 8.4, a volatility of 11, what does that mean? That means that in any given year, while on average over 38 years, I'm getting 8.4, in any given year, one standard deviation is a 68% probability. There's a 68% probability that I could get 8.4 plus 11, which would be 19.4, right? Or 8.4 minus 11, which would be negative. Okay? Why is office more volatile than the other property types? Anybody know? Has anybody here ever written or had to read or look at an office lease? Typically, you're going to, let's say, sign a 10-year lease. But what's kind of standard in the industry is I'm going to give you 1 year's free rent, sign a 10-year lease, I give you the first year free, and I'm going to put in the tenant improvements. I'm going to help finish the walls, give you new carpet, new lights, ceilings, et cetera, et cetera. So the first year is actually a negative, followed by 9 years of positive. And that creates that higher standard deviation. And then, as you might guess, hotels have a very high standard deviation. Why? Because the leases are one night at a time, and the day the economy turns down, people stop traveling, right? So they can have good years and bad years, and they bounce around a lot more. So in what we do, hotels is unique, much more difficult, so we don't really get into hotel investments, okay? So there's a little bit of kind of history on the fundamentals of what happens, okay? So let's look at the economy over time. You can see the recessions there in circles, and you can see, periods of economic growth that are long and short, and our current period, including a forecast here, kind of looks like back in the 60s, a pretty long period of time, but notice that it's a lower rate of growth in both employment and GDP, and that's why one of the new mantras out there is lower for longer. We're going to get a longer expansionary period because we've got lower rates of growth. No, not so much boom bust. I think that's really good. And obviously the new tax law has really already started to propel that, into the economy. Okay? So demand looks good, but moderate, right? Go back to Econ 101, and we always look at demand and supply. Supply of new real estate, as you can see, moves with economic cycles as well. Very high rates of growth back in the 80s, moderate in the 90s, even more moderate in 2000. And this looks like the lowest rate of growth in the past 4 economic cycles, except in the case of apartments. Why apartments? Because again, the government finances it. So I can go to Fannie Mae and Freddie Mac and get my permanent loan, which means I can get my construction loan. So we're building, we actually have great demand for apartments. The millennial generation's coming out of school, getting jobs. And so we've got a 5 to 8 year run of really strong demand growth for apartments. We're just building too many. And I'll give you my hometown example of Denver. We need 8,000 new apartment units every year in Denver. 3 years ago, we built 8,000. 2 years ago, we built 10. Last year, we built 12. We're overbuilding. If we would just back off, the developers back off, we'd move right back into the growth phase of the cycle. So we've got moderate demand growth. So we've got balance, if you will, in the economy. So since 1990, I've been doing research that is real estate market cycles. And just like the economy goes through cycles, real estate follows that. 4 phases: a recovery, an expansion, a hypersupply, and a recession. Most of you might think about real estate and you always hear vacancy rates. I use occupancy because it's visually and statistically easier to talk about. So this is, flip it upside down, it's the vacancy rate. In other words, it's kind of wacky to say things are bad and vacancies are high instead of things are bad and occupancies are low. So at the bottom, we get, this is declining vacancy on the way up, increasing vacancy on the way down. In recovery, we don't build much of anything. In the growth and the hypersupply phase, we build a lot of new stuff. And down here, we don't start because everybody knows things are getting bad. We don't start, but we're completing properties that were started ahead of that. So at the bottom, as you'd expect, if you have too much of any product, what do? You drop the price. So rents should be negative. Start to get some rent growth here, come to the long-term average, go above that. Now I'm getting strong rent growth. 0.8 is green because that's when we get to cost feasible rents. And what does that mean? Yes, sir.
Can you give an example of a city that might fit into a hyper supply?
I'm 2 slides from it. You know what the best thing for a teacher is? When a student goes, their logic's coming down the road and they're like, they just jumped ahead a step. That's awesome, thank you. Love that. And I didn't pay him, by the way, to to do that. We're going to be there in 2 slides. Higher, and then, so if it costs $400 a square foot to build a new office building here in Austin, and investors, because they're making that risky investment of a new development, need a 10% rate of return, what do rents have to be? 10% of 400 is $40. So when rents hit $40 at 0.8, we start building, okay? Still get really high rent growth, hit the peak, and when we're at the peak, demand and supply are growing at the same rate. Econ 101 is equilibrium, right? And then after that, one of 2 things happen. Either we start to build more than we need, which is what's happening for us right now in apartments, or if you remember the tech bubble burst in 2001, all of a sudden we got moderate demand and supply growth, and all of a sudden demand drops off. Anytime supply is growing at a faster rate than demand, we move into the hyper supply phase. We still get rent growth, but it's decelerating or slowing down, and then low and negative at the bottom. So I did a study with 30 years of data, and the results show. Negative at the bottom becomes positive. In this time frame, inflation was 4%, so we get that when we get to the long-term average. It starts to rise. It gets to its highest rate of growth at 0.10, and then it starts to decelerate, still very positive and strong, back through the long-term average again, and then low and negative at the bottom. So here is the cycle of office occupancies in blue and rent growth, and aren't they highly correlated? Yes, they're correlated at a rate of 79%. So if you can tell me where your city is in the cycle, I can tell you what kind of rent growth you're going to get. And any investment you'll ever make in your entire life, the total return is made up of 2 components. Income and price appreciation, right? Income from real estate comes from increasing occupancy. If I rent more space, I get more income, and increasing rents. So these 2 together drive that, okay? So where are we? Well, we can see that we've got occupancies kind of flattening out, right? And rent growth decelerating down, but being at about 4%. So where are we in the cycle? My job as an investment strategist is to help the company pick cities to go buy properties in, okay? The national average for office right now is at 0.8 in the cycle, okay? Where is Austin? Austin's at a peak. Why? You have phenomenal demand growth here. Your city is booming, right? And you're putting up just the right amount to keep that. So you're at the highest occupancy rate in Austin, Texas, in your cycle right now. And it could sit there for a long time coming. You keep getting more demand and you just put up enough supply to make that happen, you could sit there for years in a row, okay? So Houston, not very far away, is over the top and coming down. Why? Did they overbuild? No. The oil bust, they lost a bunch of jobs, so demand and supply, so demand dropped off, right? Other cities, interestingly enough, Washington, D.C. is sitting here. It's not even back to its long-term average yet. Why? They're overbuilding in D.C. So it's either a supply story or a demand story that helps us figure out what's going on. So I actually model all 54 of these cities, and we're going to do it in the 5 property types. Yes, sir.
How do natural disasters like hurricanes and that sort of thing factor into this model?
So the recent hurricanes create huge demand growth in hotels, right? So occupancies go off the charts for that. And it really depends upon what they hit and destroy. Obviously, housing is separated from commercial. In most cases, most income-producing buildings today are built such that they didn't get hit very hard. It's mostly the housing, especially in low-lying areas, that get hit bad. But most income-producing buildings are very hurricane-proof. Our building codes and everything else. I don't know if anybody and you guys have been close to some of this. You don't hear about commercial buildings having major problems, et cetera. I mean, the last one that I can think of is the big storm out east where New York City, Lower Manhattan got flooded, and you had a bunch of buildings where their basements filled up with water and they're old and their electrical systems went out. You know, so outside of that, there's not a big effect there. The one thing it is doing though is it's creating huge increases in construction costs, both materials and labor, right? I knew a couple of guys from Colorado that go, hey, I'm heading down, you know, I'm heading down south to, you know, charge double for everything I do because these people are in need, right? And obviously it's expensive for them to come down and everything else. So that rises the cost to build, which means rents have to go up even more to be able to build new.
I've got a question in terms of the correlation here to the supply and demand. What are the, and maybe you covered it in previous slides and not the sharpest tool in the shed, what are the independent variables that drive the correlation on that Austin national?
So it's demand for your city, in your city, and every city has all cities have economic-based industries. An economic-based industry creates a good or service that it exports outside of the local economy that brings money in to make it grow. And then there's something called the multiplier effect. For every economic-based employee, there are 2 local employees. Okay? So in other words, let me see if you know the concept. What's the economic-based industry of Detroit, Michigan? Autos. Okay? What's the economic-based industry or industries of Austin, Texas? Tech. Government. Education. Yep. Okay. And not K through 12, by the way, universities where you're bringing students in from outside that come here, so that's bringing money in, right? They're coming from someplace else. Denver used to be like Houston years ago, and it was mainly oil. Now we've diversified, and we've got tech, and we've got alternative energy. We've got a lot of wind generator companies there and that kind of stuff. So every city around the country is trying to diversify their economic base industries, right? And they all want clean industries, but you know, who gets them, right? What's the economic base industry for the state of Florida? Tourism and retirement, right? People retire, move to Florida, move to, you know, Nevada or Arizona or whatever, and they're not working, but they're spending their money. Okay, so that and then so it's demand and demand growth. So I literally model the employment growth for each city and then the supply for each city. Okay, and those are the 2 key variables that then give me a what's going on.
Can demand not change dynamically much faster, obviously, than supply?
Yes.
So any sort of exogenous shock to the system would immediately impact the demand.
Right. And the exogenous shock, Houston's the best example. It's impossible. It's very, very low possibility of having an upside shock where all of a sudden, boom, a new industry pops up overnight, except in Denver, Colorado. We created a whole new economic base industry 4 years ago. Marijuana, right? I call it the pot effect, right? Pot got legalized. And as a matter of fact, I'm actually going to hold that just for 1 second here. So let's go to industrial. You see the same kind of thing. You see a peaking of occupancy right now in industrial, and they forecast it coming down, but I think that forecast is wrong. I think that we're going to have a much better demand growth for industrial going forward because of e-commerce. Okay? Amazon obviously continues to grow. Last year, e-commerce was 9% of all retail sales, you know, and it's been growing at a rate of 50%. That percentage is going to slow down a little bit, but the amount is going to continue. And now, it used to be buy it and it shows up in a couple days. Now everybody wants same-day delivery or next-day delivery. So Amazon and everybody else is trying to do what? Figure out that last mile distribution. How can I get it to you the same day? Can I deliver it with a drone? I'm sorry?
The drone model, yeah.
Yeah. There are other people that I think are a little more realistic, saying we're going to have file cabinet robots on wheels that will drive around the city and drop it off to you. I know that they're using Uber in a couple of cities to deliver packages, et cetera. if you don't ever have a chance to, go into a post office, and my little post office in my town, you can see what's in the back, and more than half the boxes have the little Amazon smile on them, and the post people are just overwhelmed, right? UPS actually now goes and drops stuff off at the post office and lets them do the last mile delivery on a lot of stuff. They've got some deal going on because the post office is obviously in need of money. It's still losing money. If we look at industrial, you see that basically every market is at a peak. They're at equilibrium. We've got super high demand, we've got super high occupancy, and we're building just enough. So we're sitting at equilibrium, economic equilibrium, and it looks like this could continue for a long time. I now, because I do a lot of research there, and we have a big, we're on our 4th industrial fund at Black Creek Group. So I do a lot of research in this. And I started my research with retail, because retailers are the ones that are using, this stuff. Every retailer is trying to figure out their e-commerce platform. They're all getting into it because they know that it's the wave of the future, et cetera. So Amazon, you hear about all the time. Who's actually as large and as good as Amazon? Anybody know? Walmart. Go to the Walmart site and you'll see as much or more products available there. And Amazon is yet to make money in its 10-year history. And the major reason is returns are extremely costly. Cost of a return is more than twice the rate of sending something out. And so, let me turn that off. So they're trying to figure that out. Walmart in December started the 30-second return guarantee. So I bought some stuff from Walmart online. It arrived. I had one piece I knew I probably didn't want because it didn't fit. So I went online and I printed the return slip instead of a return mailing slip, walked into the store, special line, nobody was there, walked up, he goes, "Whoop, you're done." 2 seconds. So why did Amazon buy Whole Foods? Were they going to go and they start sending you lettuce to the house? No. They bought it because of the physical brick and mortar, right? And now they've got cabinets there where you go in and either pick up your stuff, and I don't know what they've done on their return side yet, but they needed a lot of locations for people to be able to pick up and return things because it's much more efficient to have you go the last mile than it is to have it delivered. Okay, so we're going through this phase of how is this going to work? Are we going to put in a lot of little warehouses all over the place? Are we going to take some old crappy retail and turn it into that? Probably not, because neighborhoods are going to go, no, I don't want I don't want that little store to turn into a warehouse with trucks coming in and out and everything else. So we're in a phase of trying to figure out last mile distribution, and I think we're a couple of years away from figuring that out. But basically, the projections are it'll take 10 years for all the retailers to get everything figured out. So we've got this long run of demand growth for industrial space.
Ask a quick question. Why the brick and mortar on Amazon on books? Books seem to have e-books. I mean, books seem to have absolutely no overhead if you're doing online distribution
Yeah.
for books. So why would Amazon be doing brick and mortar?
Right, and I was just in Washington D.C. and walked by in Georgetown, opening soon Amazon bookstore.
Why would you?
Some people still like the physical tactile book, and I guess there's enough of them that they're paying for it. It does.
Doctor, there's a pretty good literature about that talks about, that addresses the idea in terms of learning, that ebooks have a poorer chance of the student learning rather than having a paper pencil notation and annotation in the book.
And actually, I'm going to agree with that, and I'm going to then give you one light little story here too. I teach at Harvard every year. Harvard Business School has now banned computers from the classroom because students got their computer open and they're listening to you and they're also doing something on their computer, and multitasking is not possible. You go from one thing to the next, and when you do, your retention rate is 50% or less. So I now, first day of class, I go, look, unless you can prove to me that you are taking notes, your computer's not open. And whenever we have a guest lecturer, you need to not disrespect them. Computers have to be closed, period. Okay? And if you can't, you're paying a lot of money to be here. If you can't put your phone away for 2 hours, you have to communicate, then step out of the class. So it's unfortunately can be disruptive. So now back to, so where's Austin? Austin's just a little over the top because you've been putting up a little too much. Denver's even further. Main reason, our pot industry 4 years ago took and leased up every old piece of crappy warehouse in town to become grow rooms for pot, right? Rents went from $3 to $6 a square foot. The cost to build new is about $350. So then developers, wow, I can build a new place where I should be getting $350 a square foot for rent, and I can get $6. So we're overbuilding Denver's, warehouse right now. Okay, apartments, you can see they actually peaked back in 2015, and their occupancy rates are coming down, and their rental growth has dropped off now. So just about everything is in the hypersupply phase, including Austin. And oh, by the way, 2 things you should know about these slides are, number one, you see some numbers behind the slides. And what that number says is, where was this last quarter and did it move? So Austin was a little further over at position 13. We slowed down the supply a little bit and it backed up to position 12. Okay? Hartford was a little bit in oversupply, it's backed up and it's now back to its peak occupancy level. Okay? If we could slow down new supply, all that stuff could jump right back into the expansion phase of the cycle, which we're now seeing banks saying, okay, you gotta give me a little more, I want a little more equity in here, so we are starting to see a slowdown of supply a little bit.
On any of the separate slides, what's the greatest movement you've seen in the city? How many numbers have moved?
Sometimes 3 or 4 at a time, and these are quarterly, right? In a quarter, and that's because we had like a big boom that came along in some case, and sometimes it's the other way around. We built a brand new humongous building in a smaller city, and it drops backwards, right? Because occupancy goes down as they're trying to rent up that new space. Good question. The other interesting thing is you'll notice that there are some cities that are in bold and italics here. If we looked at each property type, because many times I'd have big pension funds that go, look, we're only going to go to the big institutional quality cities. So I took all these 54 cities and sorted them by size, by square footage of space, right? In office, it takes 11 cities to make up 50% of all the square footage. In apartments, it takes 14 cities to make up 50% of all the square footage. So there are what we call the institutional cities. And so Austin, Denver, Nashville, as an example, are second-tier cities. We're a little bit smaller. But basically all these cities they've got a population of 500,000 or more. Okay? Retail, everybody says retail's doing bad. Well, look at the occupancy levels. Occupancies in retail are higher today than they were in the last 2 cycles. So everybody thinks it's crashing. It's not what the statistics tell me. But we are, in essence, oversupplying a lot of it. Austin's just a little over the top, having gotten better in the last quarter. And by the way, this is my forecast out into 2018, too. So this is where I think we're going. And then finally, hotels, national average, just a little bit over the top, mainly because we've built a lot of new hotels. In history, average occupancy in hotels has been like 65%, because when you think about it, a business hotel is full Monday through Thursday and fairly empty Friday, Saturday, Sunday, and resorts are full Friday, Saturday, Sunday, and not so much during the week, right? Now, national average for the last 2 years, we've been above 70%, so hotels are making really great money right now, and that could run for another couple of years, okay? So far, all I've talked about is, I call it the physical cycle, demand and supply for space. It's very local in nature, city by city, right? And that drives the income. Occupancy and rents drive my income. Now let's talk about prices, okay? What moves prices? The answer is capital flowing in. A lot of people come into the stock market and stock prices go up. People yank their money out and stock prices drop. Everybody's afraid of what's going to happen and they put their money into bonds. Bond prices go up and bond yields stay low. What do you think is going to happen over the next 4 years in the bond market? Are people worried about the stock market being too high and it dropping? So what do? They leave their money in the bond market. So I actually believe that bond prices will stay down. Interest rates are going to stay low. Every year, every economist said interest rates are going up, interest rates are going up, and they've been doing it for 7 years, and they've been wrong. Is it going to go up a little bit? Yeah. Is it going to go to 3? Is the 10-year treasury going to go to 3 this coming year? Not with all, the world is awash in capital right now. So where else can we go? Well, one place is real estate. So when things are bad, nobody's putting money in, very little capital flow. As things get better, people start buying. We go at the highest rate of capital flowing in as we go through cost feasible new rents, peaks out in the high supply phase, and then drops off very quickly. But there's 2 types of capital that flow to real estate. One, the shaded area up here, is capital flows to existing properties. So if you pay me a higher price than I paid for the property, more money just came in. But then we also build new. So here we are putting new capital into new construction. While we stop buying existing properties when we realize things are going to turn bad, we started a property here and we're still putting the money in to finish it down here. So, got a great company called Real Capital Analytics that started in 2000. They started collecting data on every single property transaction in the United States, income producing property transaction over $2.5 million. Okay? Have many of you heard of or seen in the paper the Case-Shiller Home Price Index? It tells you what the price of homes is. Look in the financial news and you'll find that. And so they track housing prices in major markets around the country, and they tell you what's going on. You know, house prices were up 8% last year on average across the United States. They were up 15 in Denver, and I think it was like 12 in Austin. So you can look at your city versus the national average. Well, these guys, along with Moody's, which is a company you may have heard of, does the same thing. So here's capital flow at $20 billion a quarter, going up to as high as $160 billion at the peak of the market in 2017, dropping off to below $20 billion during the Great Recession, and heading back up. And you can see the price moving up and down and back up. So everything that we lost in the Great Recession, we basically regained, and we can break it down by property type, and you can see that CBD office, that central business district or downtown office, is now 30% higher than its 2007 peak. Apartments are 150% of their peak, whereas industrial is 10% higher, retail has not quite regained everything, and suburban office is almost there as well. So we can see what's happening in the different property types, and we express the kind of prices of real estate by looking at the return. We call it the cap rate, which is just like a bond yield. If I buy back here in 1989, if I bought a property and got an 8% yield, so if I bought a $100 million property, I was getting an $8 million income off the property, cash on cash return. Does that make sense to everybody? Okay. And when we had the recession in 1991, prices dropped and cap rates went up to 10. And then as the economy improved, prices go up, cap rates come down to mid-year 1998. And then the technology boom, later called a bubble, started. And we went, who wants an old economy investment like real estate? We're not going to buy a tech stock that goes up 100% in 6 months. And so capital's not flowing in, prices go down, cap rates come up. The day the tech bubble burst, everybody says, give me that hard asset, give me something that's not going to vanish into cyberspace. And capital flows in, prices go up, cap rates come down. The Great Recession starts and everybody goes, well, the income on that real estate's not going up, so I'm not buying. Prices drop, cap rates come up. Second quarter of 2010, employment growth turned positive, hence the outlook for real estate turned positive. People put their money in, and now we're looking at cap rates in the 5 to 6.5% range. So when you look at that, you go, but so real estate historically looks expensive. Right now it looks expensive, right? Compared to what it's been in history, why should I buy real estate right now? Well, the answer is this. Your choice is stocks. Do you think they're high? Bond prices, do you think they're high? So the way that we look at returns right now is how much am I getting over the risk-free rate of buying a 10-year treasury? I can buy a 10-year treasury right now today at 2.6%, and I'm guaranteed to get 2.6% for the next 10 years and get my $1,000 back on that bond if I hang on to it for the entire time. But if inflation's above 2.6, I'm losing money in real terms. So we look at the spread over it. How much additional over the 10-year treasury, the risk-free rate, am I getting for taking the risk of investing in real estate? Back in 2001, I was getting 3.75% higher, 375 basis points. In 2007, I was only getting 150. Today, I'm getting somewhere between 350 and 500 basis points above it. So on a relative basis, I've got to make an investment today. I can't do it yesterday. Real estate looks like a screaming buy. Yes?
Is the correlation of the profitability of real estate, is there not some correlation to the investment or the animal spirits of people who have made money in the market? In other words, if you're making money in your real estate investment, is it not based somehow on the incomes of those people investing in real estate who are making money elsewhere? I feel better about investing in real estate because my stock market portfolio looks so good. I'm going to go spend money on real estate.
Yes. Yeah. In other words, the better the economy is doing, the better real estate does. Okay? Interestingly enough, the publicly traded companies, the publicly traded REITs, everybody says, real estate is really like a financial stock, which is not true. So if interest rates go up, cap rates are going to go up and prices are going to drop. The actual correlation between interest rates and cap rates is 0.06%. It's very low. And think about this. For interest rates to go up, what has to happen? The economy's got to do better, GDP's got to grow, employment's got to grow, which means demand for real estate's going up, so occupancies and rents go up. And as you saw historically, they go up much faster than inflation, so we get more than double the return. So actually, the financial markets, because they don't really understand real estate well, the publicly traded stocks are being hit because of that, okay? So, and real estate in my now 40 years, when I started in the 1970s, almost all income producing real estate was a local deal. Local buyer, local seller, local bank doing the financing. 1980s is when the pension funds and endowments got in, national buyers, national sellers, national financing. In the 1990s, we got our first access to the public capital markets, the stock market with REITs, and the bond markets with something called CMBS, commercial mortgage-backed securities, where just like Fannie and Freddie, we figured out how to pool and do mortgages for commercial properties. And since the year 2000, we've become global. And this is actually a little bit older slide, but blue lines are the U.S. investing money in other places, and the other colors are other countries bringing money into the United States. So today, in New York City, a Class A office building is going to go for a 4.5% cap rate. You're going to get a 4.5% cash-on-cash yield on your New York City office building. In London, the cap rate's 2.5%. So the U.S. looks like a 50% off deal for an international investor. And the interest rates in Germany are negative, and most other countries, they're next to zero in Japan. So one of our biggest capital flows has been Japan into the United States. China was number one here with $7.7 billion into the U.S. in 2014. So my conclusions, real estate is a separate asset class. It grows with the economy and mainly with employment growth. Okay, it's been a 2x hedge against inflation historically. It's a great diversifier to your portfolio of stocks and bonds. Total real estate return is about 60 to 70% income and 20 to 30% price appreciation. So it's bond-like income and not quite stock-like appreciation is a good way to think of it. Right now, coming over, we were talking with a hedge fund manager who said, "I am out there trying to find yield, and trying to get find investments where I can get a 2% yield with some sort of potential price appreciation sometime in the future is really, really tough. When you can buy real estate with a 5% yield, why wouldn't you be doing that?" We've had income improvements since 2010. Prices have recovered, and we expect them to keep growing. Property types perform differently, so making investments is important. It is, so we're really in the expansion phase of the economy, which means we're in the expansion phase of the real estate cycle. And professional management is important. Every major university in this country now has real estate classes. Why? because it's a profession. We have, right now, we put out a weekly email to all our students, and I have minimum of 10 jobs and internships available every single week for my students. Every company's like, I need people. I'm looking for help. From the construction side, I need a project manager, to the real estate, now I need someone to help me with acquisitions, property management, whatever the case may be. So that's my story. I'm sticking to it. We're now going to have a speed reading test, right? I must give you important disclosures and certifications. Everybody got it? That's my story, and I'm sticking to it.
Any questions for Doc before we let him go? We good? Any questions? It was good during the session, so appreciate the interaction. Thank you. Appreciate you. All right, very much. Real quick, to dovetail that, I'd like to bring up Alan Brown. He's also with Black Creek Group. He is head of institutional sales. He's going to talk for 5 to 10 minutes about the impact of e-commerce, all right, and then also a few things about 1031 exchanges. Post that, we will move right here. We got food set up. We'll move through the line, get our food, and then First Trust will be here. Bob Stein will be talking about the stock market, et cetera.
You probably can hear me anyways, and for those of you who haven't picked it up, I'm originally from Boston, so you're going to pick that accent up, and I had to do this to Mark, but I brought my Patriots cufflinks there today, so making no fans right at the start. Thank you very much. What I want to do is I'll spend 5 minutes to tell you a little bit about Black Creek, and then 2 of the real estate solutions that we have that Mark has the ability to access right now. So as a firm, Black Creek, institutional, private equity, commercial real estate. We've been in the business 25 years. We've done over 18 billion in transactions. We have about 300 employees in 9 offices around the country. We started in the institutional market. Our clients are Cal Sturz, the Notre Dame Endowment, the Governor of Singapore. And then in early 2000, we said, to a lot of things you saw from Dr. Mueller, how do we take the benefits, correlation, low volatility that institutions have enjoyed, and bring them to high net worth clients? So in 2000, we started another division here in the US that just has what I would say more retail solutions that allow people to access commercial real estate. So the one I really want to talk about today is industrial. So that has been one of the fortes of our firm. We've done 13 billion in industrial transactions over the last 15, 20 years. We've actually done 9 funds, and this is our 4th core fund that we're offering right now. So I'll start with a story, since I'm a storyteller. How many receive one of these? Selling smiles all day, right? So I actually, in full disclosure, worked at Amazon. In 2000, I was the first chief marketing officer for the company. And back then, every single executive had to go work in a distribution center. So I worked in one of the original 5. I worked there for Christmas. And late one night, I'm in Reno, Nevada, packing boxes, and it's 3 football fields long, and right down the end, and a woman comes up to me, and she was having trouble with the scanner. And she says, I'm not figuring out, I have to rescan this. And I says, well, I can either try and fix it, or I'll run downstairs and get someone from tech. And she says, no, you're packing boxes a lot faster than me. You're way too valuable. I'll go down. And I looked, and this woman was in her 60s, and she starts, I'm like, no. She says, oh, wait, my husband's coming. Her husband comes up. He was working also, and they're working at it, and they can't get it. And I said, look, let me run down. She said, no. Oh, my daughter-in-law's coming now. So it's kind of a family affair. So I see the daughter-in-law walking up, and I look, and I stop, and it's Mackenzie Bezos, Jeff's wife. So all of a sudden I realized I've been packing boxes with his mom, who owns 9% of the company, and his dad, who owns another 6%. And I was like, thank goodness I was using my manners. So, but to the interesting part of the story, so in 2000, Doc talked about population. Population, when I left Amazon in 2000, in the US was 282 million. Now it's 336. So you have 53 million more people. So you can see just in all those asset classes the need and growth. Amazon had 5 centers then and 6,000 employees. Today it has 260 centers and I think somewhere over 300,000 employees, not counting the Whole Foods acquisition. So you've seen that tremendous, tremendous growth. In industrial, it takes, for every billion in sales, it takes 1.25 million square feet to service it. So it takes 3 times more industrial space to service retail sales than it does in the brick and mortar world. So what you're seeing in that supply-demand curve is there'd been the natural growth of industrial due to global supply chain, everyone going towards e-commerce, but you've added on now an e-commerce effect that is really, really helping that marketplace. So we just started our 4th fund, and what we've been doing is buying industrial centers and distribution centers around the country. So that's Black Creek 4. Any questions on that? Any Amazon questions? I heard the book one, and so the reality there is they wanted to go back out with a few physical spaces to showcase. It really is just a showroom effect. The way people used to go into Best Buy, take a picture, and then buy it on Amazon, they now want to have a few more physical places. And on the Whole Foods acquisition, for those inside baseball, they haven't been able to figure out grocery for 15 years. I actually worked on some Amazon Fresh in 2001, and they realized the need for the last mile, so that's why they bought that footprint. So we have an industrial fund out there. It is our fourth. Right now, its yield on the institutional share, which is eligible for everyone in this room, is about 5.4. So again, to Dr. Mueller's point, if you are looking for yield, with the Dow at 26.3 and the 10-year at 2.6, where do you go if you're allocating money? An allocation to real estate can really help in portfolio construction. It's going to dampen volatility. It's not correlated to the other major asset classes, and direct real estate is probably one of the best ways to do that. Second thing I want to talk about, as we've seen in those charts, highly appreciated real estate. So a lot of folks who might have a low-cost basis, what do you do with that real estate? We have a very unique 1031 exchange service. It's patented, and basically, not to get too complex, is you sell that building, you 1031 into one of our buildings in a Delaware statutory trust. We then, after 2 years, bring that back into our $2.5 billion fund, and you as a owner now have divisible units that you can divide between heirs, have a stepped up cost basis, and then you're not actively managing real estate anymore. And through that whole cycle, we have a master lease on top of the 1031 that gives you about a 4.5% return, cash on cash, and then when you come into the larger fund, you get both that return and appreciation. So it's a great service. It really gets you out of managing real estate and gets you into a really well-diversified portfolio. So that master portfolio is $2.3 billion with about 60 assets around the country. So that's my story, and I'm sticking to it. And I don't want to be in the way of lunch, so if there's any questions, fire them now. Or
Speaking of insider baseball.
I'm sorry?
Speaking of insider baseball.
Yes.
Any thoughts on the finalist cities?
I get asked that. No. I get asked that a lot. I get asked that a lot. If I was a betting man, I think Washington D.C. has a great shot for a couple. So in the criteria, is it 1 million people? Do you have great service? Do you have great universities? There's a lot of cities hitting that, but the ability to lobby. So there's been a lobbying office there since '98. Jeff owns a house there, and he owns the Washington Post. And I do think they want an East Coast. I think New York's too expensive. Boston's too small. Might be D.C. Chicago would be in there. I live in Chicago, but has everything they want in terms of size, affordability, everything else, but crime and taxes are just a little bit too much, I think.
And Denver?
I don't think so. Denver doesn't have the, that's where we're headquartered, doesn't have the infrastructure in terms of public transport. It's public transport, a good subway system, good, and same time zone, almost. So I do think they're going to want an East Coast base, but that's just an opinion. That's no inside baseball. Educated guess, yeah. Yes, a money ball. So, thank you all for your time, and I'll put it back to Mark.
Thank you, Alan. Appreciate it. All right, we're going to break for lunch. Got a break, got restrooms, and then break for lunch. You can bring it back in here, and then we'll get Bob Stein whenever he gets here. We'll get going. So. Okay, everybody. We are going to try and keep on a tight schedule. Our next speaker, he is just spoke, and he's on his way to another engagement. So I figure we'll just kind of double up. We'll eat and listen to Mr. Stein. As many of you know, and some of your portfolios actually have in them a company called First Trust. We value that relationship with them. They are one of the largest money managers in the country. And we were just at one of their conferences yesterday where they are rated number one in terms of research. And so they're a great resource for us. We outsource some of our money management to them. And so we're very fortunate to have them. Jared Crow on the left is our direct relationship. And we're fortunate enough to have Bob Stein here, a deputy economist from Chicago with First Trust. With that being said, tremendous content. We heard some of this yesterday, and I think you'll find it very relevant. We're going to be talking about markets, political environment, economic outlook, et cetera. So with that, pass it off to you, Bob, if that's cool. Thanks for being here. Really appreciate you.
Thank you very much, Mark. I appreciate it. First thing I want to do is thank everybody for taking the time and coming here today. I appreciate that you have other things to do with your time, other places you could be, and that you chose to do some of it, spend it here today, and hopefully pick some ideas up. What I'm going to do in a little while is talk about the economy, and in particular talk about some of the scare stories people have been hearing over the past few years about why we're about to have a major day of reckoning, kind of like 2008 and 2009 right around the corner. But before I do that, let's talk a little bit about politics. Okay, now don't get scared or run from the room. I'm not here running for Congress. Okay, I'm not going to talk about the way I want the world to look. I'm going to talk about what I think is going to happen later this year with the midterm elections. So a year into the president's term, and what always happens 1 year into the president's term, is people start thinking about the verdict that's going to be rendered in the midterm cycle coming up. So we're now around, 9.5 months away from these midterms. If you look at public opinion polling, if you look at the Republicans and Democrats' performances in various congressional districts around the country over the past 12 months, if you look at the historical record where back in 1994, 2 years after President Clinton wins, his party is wiped out of the House of Representatives and loses control. First time the Democrats lost control in more than 40 years. And back in 2010, 2 years after President Obama won the White House, his party is wiped out of control of the House of Representatives. I think the weight of the evidence is that most likely the Democrats will take back the House. It is not going to be a slam dunk. There are very few very competitive districts around the country, and so it will be tough to do, but I think the weight is that probably 60 to 65% that the Democrats take back the House. In terms of the U.S. Senate, you would think that if the Democrats catch enough of a wave to take back the House, given that the Republicans control the Senate 51-49, it's very narrowly in the Republicans' favor, that they would take back the Senate as well. But of the 34 Senate races up for re-election later this fall, the Democrats have to defend 26 of those 34 seats. The Republicans only have to defend 8. And so even if the Democrats do really well at competing for those 8 seats that the Republicans now hold, even if they knock off 35 to 40% of the Republicans who hold those seats, all the Republicans would have to do is knock off about 11% of the seats that they're competing for, now controlled by the Democrats, and that would fully offset what the Democrats do. So I think given the terrain on which they are doing battle this year, the political terrain, which otherwise favors the Republicans because so few Republicans have to run for re-election this time, that the most likely outcome in the Senate is going to be the opposite of the House, where the Republicans keep control of the U.S. Senate. It's probably going to end up right where it is today, 51-49. And right after that midterm election happens, people are going to turn to the discussion of whether President Trump is going to run again. And normally you would think, given the historical record, that you would have to go back almost 100 years to find a sitting president of the United States fully legally capable of running again who does not run again at all. Well, I know some of you are thinking, well, what about Lyndon Johnson in 1968? Lyndon Johnson ran in the New Hampshire primary in 1968. Lyndon Johnson won the New Hampshire primary in 1968. But a couple weeks later, he didn't win it by much, or as much as he expected. A couple weeks later, Robert Kennedy gets in the race, seeing an opportunity, seeing blood on the water. And a couple weeks after that, Lyndon Johnson goes on national TV and says, I am not going to run anymore. In 1952, Harry Truman could run, and he tried to run. He ran the New Hampshire primary, and like LBJ, 16 years later, decided he didn't do well enough to continue in the race. You would have to go back to Calvin Coolidge to find a sitting president of the United States who decided not to run again. But if there's anything we've learned over the last couple of years, it's that Donald Trump is a unique politician, okay, to say the least. So let's look at what the United States is going to look like by mid-2019, by which point he will definitely have to decide, at least in his own mind, whether he's going to run again or not. And by mid-2019, here's what he's going to look at. He's going to look at his predecessor presiding over an economic growth rate, on average, once the economy got back to recovery, of about 2% per year. And we had 2.5% last year, and probably around 3% or so this year, and 3% or so next year. A little bit of an acceleration in economic growth. The unemployment rate, which is now 4.1%, by the middle of next year will be at or very close to the lowest since the early 1950s, about 65 years ago. Nobody's talking about it right now, but over the past 12 months, typical earnings for people in the bottom half of the income spectrum have actually been growing a little faster than for people in the top half of the income spectrum. You can bet that in 2019 and 28, actually, frankly, later this year, President Trump, if it continues, will be talking about that. Then you think, has there ever been a president in our living memory who has multiple homes that are nicer than 1600 Pennsylvania Avenue? I mean, the guy goes away every weekend. Why does he go away? Because he's slumming it at the White House. Okay, he didn't even want Air Force One. It wasn't good enough for him. Okay, so I can see. I think that in my mind, I think in 2019 he's going to sit back and say, you got to get into his head. I ran to make America great again. It's great again. I mean, what's not to love? And he's just going to walk away and say, I'll leave it to you idiots to ruin it again. And maybe I'll come back 4 years later if you totally screw it up. So I'm not saying he won't run. I'm saying I think the weight of the evidence is slightly more likely that he will not run rather than he will. Now, if you happen to like President Trump, here's your solace, okay? Back in 2016, I never thought he'd be nominated. Once he was nominated, I never thought he would win, okay? So I've been wrong about Donald Trump all along, and I may be wrong again. Now, in terms of the economy, let me go through those horror stories that I hear over and over again about what's going to happen to the United States very soon. First one is about the federal debt. I hear over and over again the federal debt is at a record high. We're projecting budget deficits as far as the eye can see. If anything, the annual budget deficits over the next couple of years are going to be even higher than they were in President Obama's last few years in office. And so why should we be investing in equities when we know that eventually the United States is going to become Greece? And it is true the federal debt is at a record high. But despite that record high debt, it's right around $21 trillion right now. Despite that record high debt, the interest on the debt, whether you look at it relative to GDP, the size of our economy, whether you look at it relative to federal revenue, still hovering near the lowest levels in the past 50 years. Now, I'm not going to tell you there's no problem with the federal debt. We still have a major problem with the federal debt. It's just not the one that most of us believe it is. To me, the biggest problem with the federal debt is that it's not the amount of the debt, it's how we're financing it instead. The United States Treasury Department is still financing the federal debt with securities with an average maturity of less than 6 years. We've seen over the past few years at least 5 countries issue 100-year bonds, century debt. Austria, Belgium, Ireland, Mexico, and Argentina. Now, that last country I mentioned, Argentina is a country that's defaulted 8 times in the past 200 years. And people are willing to buy century debt from Argentina. Now, it's Argentina, and so the yield is 7.9%. For Mexico, 4.1%. Ireland, 2.35%. Now, I'm not saying the United States should only issue century bonds. Quite to the contrary. All I'm saying is that we need to reshuffle the mix of securities we're issuing. Start to issue a higher distribution of 30s, some 50-year bonds, maybe even some 100-year bonds, to lock in low interest rates over the long run, to give us the breathing room we need long-term to tackle issues like Social Security, Medicare, Medicaid, the Affordable Care Act, other entitlements as well. The other issue I've seen more and more about lately is about consumer debt. Household debt, mortgages, home equity loans, credit card debt, student loans, automobile loans, everything combined. It's at a new record high, even surpassing the worst of the problem back in 2007, before the Great Recession and before the financial crisis. The thing is, though, this is the raw level of household debt. If you compare that debt to the assets we have to pay it off, it paints a completely different picture. Relative to the assets we have to pay off those debts, the debts are at one of the lowest levels in the past generation. Now, this is a stock-to-stock comparison. You're looking at the total amount of debt for households relative to the assets they have to pay it off. Another way of looking at this is something called a flow-to-flow comparison. Sounds technical, it's really not, and we have a ready-made statistic that already does it for us. It's called the financial obligations ratio. The Federal Reserve prints it every 3 months, but it's not on a regular schedule, and so nobody pays attention. To me, it is by far the most underrated indicator about the U.S. economy. It's basically all of the payments that all of us make month in, month out, based on the things we've already purchased. So it's our mortgage payment, interest, principal, property taxes, homeowners insurance. It's our rent, if we don't own, we rent. Payments on car loans and car leases, debt service on credit cards, student loans, other lending arrangements. All those payments combined relative to income back in 2007, before the crisis, were at a record high. No wonder there was a crisis. A couple of years ago, we were at the lowest levels already since the early 1980s. Now it is creeping up, and if I'm invited back a couple of years from now, it may be at a point where it's a problem. But today, it is still relatively low. What that tells me is that consumers are still in a position where they have a little bit more room to lever up. Now, I know there are other stories out there about the consumer. And so if you follow David Stockman, the former budget director under President Reagan in the early 1980s, you follow Porter Stansberry, Jim Rickards, a lot of other analysts out there, they're using some, I guess what you would call alternative facts about the consumer to paint a picture of a dire circumstance. And here's part of the story they say. They say if you look at serious delinquencies among automobile borrowers, and by serious delinquencies, I don't mean just one missed payment by accident. I mean 90-day delinquencies. So at least 3 missed payments in a row. That we are at a new record high, easily surpassing where we were at the peak of the problem in the aftermath of the financial crisis. That if you look at student loans, serious delinquencies among student borrowers a decade ago, we're running about $40 billion nationwide. Now it's $150 billion nationwide, almost 4 times where it was only 10 years ago. And if this slide and the previous slide is all you see about the consumer, you can be totally convinced we're headed for a major day of reckoning. But I want you to pay careful attention to the scales on this slide. For auto loans, it goes up to $50 billion. Sounds like a lot of money. For student loans, it goes up to $160 billion. The reason I want you to focus on the scales on these slides is because these 2 scary looking lines right here are no different than these 2 lines right here. Now obviously they don't look as scary anymore because I changed the scale on the slide. This one goes up to $1.2 trillion. Not 50 billion or 160 billion, 1.2 trillion. But the reason I changed the scale was not to create some sort of optical illusion and trick everybody. The reason I changed the scale was because I had to fit this blue line on the same slide. So what's in this blue line? The one that's come down substantially over the past 8 years. The first thing that's in this blue line, everything in the purple and red lines. All those serious automobile loan delinquencies, all those serious student loan delinquencies, they are in the blue line as well. But the blue line also includes delinquencies on mortgages, home equity loans, credit cards, other types of loans like signature loans from banks, things like that. All of it combined, down substantially over the past 8 years. If you ever want to take apart this blue line at any point in time, you can do that. You can find the 1 or 2 things working in the wrong direction, and you can focus like a laser beam on just that information. And everything you say about them can be 100% true. But those are the molehills. You need to be focused on the mountain of seriously delinquent debt left over from the previous decade, down substantially over the past 8 years. Yes, sir?
Quick question. Is part of that because if we look at the amount of people getting debt, if I did that as a percentage of total debt, would that still look really scary?
So what you're talking about is the amount of serious delinquencies relative to the amount of debt?
To the total amount of student debt. Is it, was it 10% and now it's 50%? Or is it, the amount of student debt grew so much?
Are you looking at the ratio of this or like the internal ratio for student debt?
Yeah, just.
Oh, no. Yeah, the increase in delinquencies for student debt is in part driven by just having more debt. But it's the delinquency rate is up substantially as well.
Okay, so that percentage rate is higher.
That's correct.
Okay.
Yeah, the delinquency percentage itself is substantially higher.
Okay.
Yeah. So the other story I hear about debt is about corporate debt. Now, most people understand, most investors understand that the banks are in a much better financial position than they were a decade ago. The regulatory environment's tougher. Their capital standards are higher as well. But some people are concerned about debt in non-financial corporate America. So corporate America excluding the banks. And if you look at their debts, those are at a record high as well. But if you look at the debts of non-financial corporate America excluding the banks, you look at it relative to their assets, it's well within the normal historical range. When you look at their debt payments, including leases and things like that, relative to their profits, it's well within the normal historical range. Superficially, I hear all these stories about going to hell in a handbasket because of debt right around the corner. And we may eventually do so, okay? But for at least for the next few years, none of these pictures show a country suddenly unable to pay its debts with the assets it has, and suddenly unable to make its payments as they come due. When you look at the details of the situation, we're no worse off than we ever have been before. In terms of investing, there's one thing I do want to mention in particular, which is that I know many retail investors, at least that I've spoken to over the past several years, kind of let sometimes their personal political preferences cloud their judgment about when to invest. So I can't tell you how many investors over and over again I've talked to over the previous 8 years under President Obama who said that the economy was really not growing, that the bull market in stocks was all a castle made of sand, it's all an illusion, that the unemployment rate really wasn't coming down because they didn't like the president, and so nothing could be good. And now I hear from people on the opposite side of the aisle saying just pretty much the same thing, frankly. That the bull market can't be accelerating, that the unemployment rate doesn't keep coming down because President Trump's in office instead. So let me, if you think that way sometimes, let me give you a piece of information to try to convey why the U.S. economy is going to continue to grow over the next few years, regardless of who's sitting in the Oval Office, regardless of who controls the White House, regardless of what happens in Washington, D.C. And that reason is housing. Normally in the United States, based on population growth, based on scrappage rates, and by scrappage I mean voluntary knockdowns, fires, floods, hurricanes, tornadoes, earthquakes, mudslides as well, we need to start around 1.5 million homes per year. Now we were down at around 500,000 per year at the beginning of this decade, but that made sense because we were working off the excess inventory that developed in the previous decade. We've recovered substantially over the past 6 or 7 years, and we're back to 1.2 million. What that signals is that if we need more housing based on population growth and scrappage rates, that housing has further to grow. Home building has further to grow over the next couple of years. That means more floors for floor coverings, more walls for flat screen TVs, more rooms for furniture and appliances over that time frame. For a completely non-political reason, nothing to do with Washington, D.C. The U.S. economy is going to continue to grow for at least the next couple of years. Now, I don't want to leave you with the impression that I'm only bullish about each and every aspect of the U.S. economy. Let me give you a couple of areas for caution, or at least one in particular, and that's autos. Back in early 2009, Americans were buying cars at about a 9 million annualized rate. Slowest pace of auto sales since the 1960s. So we put our heads together all the way back then, 9 years ago, to try to estimate where sales would go back to once the economy got back toward normal. We estimated based on growth in the driving age population, based on scrappage rates, automobiles only last so long, that we'd eventually get up to around a 15.5 million annual rate. Now stop for a second. Think about what it was like for me to stand in my shoes 9 years ago, traveling around the country, speaking to smart investors like in this room today, telling them when the unemployment rate was at 10%, that I think auto sales would go back to a 15.5 million annual rate. To be honest, people like you thought I was an idiot. I mean, hadn't I heard? Millennials are never going to drive. They're never going to shave, they're never going to bathe, they're never going to drive. Remember that story? Goodbye gas guzzlers, we'll all be driving smart cars. That was another story I heard. By the way, we own and are buying more light trucks than ever before. I was in Arizona last week for business, traveling between Phoenix and Tucson. It's like every other vehicle was a Ford F-150. It's like the national flower of Arizona, probably Texas as well. The other story I like the best, coming from a decade ago, is that the United States of America was heading towards European levels of car ownership. No more one car per adult like the previous generation. It's just going to be one car per household, just like they do it in Europe. And only 4 years later, we're right back, 2013, we're right back at 15.5 million. The problem, in my view, is that for the past few years in a row, we've been consistently above that pace. We hit a calendar year record high for auto sales back in 2015. We hit another record high in 2016. Back in 2016, we bought cars and light trucks at a 17.5 million annual rate. But notice something. In 2017, last year, despite the surge in auto sales related to Hurricane Harvey and Hurricane Irma, we only hit 17.2 million annualized. Again, despite that artificial surge from the hurricanes, we were still lower than 2016. Automakers are saying we're going to buy 17.1 million cars and light trucks this year. I think they're too optimistic. I think it's going to be like 16.7 instead. And I think it's going to continue to go down over the next few years. Doesn't mean we're going into a recession. Doesn't mean we're getting anywhere close to where we were at the depths of the recession in 2009. Does mean it'll gradually decline over the next few years back to a fundamental pace of around 15.5 million. Now, I love consumer discretionary stocks. As I mentioned earlier, I think the problems with the consumer, the financial position of the consumer is much better than most people give it credit for. But I don't like autos. So if you can find a way to invest in consumer discretionary stocks, but take out the auto stocks, I think that's a great place to be. I mentioned at the beginning, hopefully we'll have time for questions. Why don't we go to those now? We're a tight schedule, so feel free to pepper away.
Well, emerging markets, are we in early innings or late innings of emerging markets?
Are we what?
Emerging markets?
Yeah.
Early or late innings there, it's been pretty strong, like the FEM, and where are we with MLPs?
Yeah, I can't tell you anything about MLPs. I'm not like the product guy at First Trust. I can give you my own personal opinion about emerging markets, which is historically the outperformance of emerging markets relative to the US is very counterintuitive. That the outperformance of emerging markets historically has been when the US has been raising interest rates, which doesn't make intuitive sense. You'd think that if we raised interest rates, money is going to pour into the US and be withdrawn from emerging markets. Historically, the record is different, though. I think we're going to continue to be in a rate-raising phase this year. The market has come around to the view of the Fed recently that there will be 3 hikes, although the market thinks if not 3, then 2. We think at First Trust, if not 3, then 4. Okay? We're going to see more rate hikes next year as well. Probably 3 this year, 3 next year is most likely outcome. Maybe a couple more in 2020 as well. Until the Fed sees enough of a sign of a slowing in the economy to stop raising rates, I think the emerging markets will, although more volatile than US markets and an advanced world like advanced European and Japan markets, although they'll be more volatile, that they'll tend to outperform. Once the Fed, you're confident that the Fed is stopping, get out of emerging markets because the US economy is going to slow and they're going to feel it. You have countries around the world, like Vietnam, countries like that, where a large share of the GDP is exported into the United States. And so that's what we have to be concerned with.
So we're still good there.
I think so. Now, does that mean there won't be a correction along the way? If we have a correction, they're going to have a worse correction, okay? Most likely. But overall, if we continue to grow like we expect in the equity markets in the US over the next couple of years, emerging markets on average should outperform. Thank you very much for your time. I hope you found this useful.
Hey, our next speaker is with a firm that we value, got a great relationship with, an alternative money manager here in town, Vita Capital. We've been tracking their progress for quite some time. We have several clients that participate in that offering. They have grown by leaps and bounds. They've got a really unique asset class, and we're fortunate to have Ann Buchanan here with us. She's the head of institutional sales for Vita. And And so we just wanted Ann to come here and just share a few minutes about Vita and all that they're doing as another extension of alternative investments outside of traditional markets. All right?
Thank you, Mark.
Appreciate
I
you being here.
appreciate it, of course. I know y'all probably had a pretty full morning, so I think I can keep this somewhat brief and high level, and then I'd love to take any questions at the end. But yeah, as Mark mentioned, we're a local firm. Vita Capital was started here in Austin, Texas in 2009. Jeff, Sarah, and Austin Ventures helped found this firm. Basically, what we do is we manage around $3 billion in equity capital in institutionally managed longevity contingent assets. That's a long way to say we manage large, diversified life settlement portfolios. Now, the good and bad about the asset class is there's a very negative stigma that is pervasive, even till today. Folks think about viaticals of the 80s. They think about fraudulent policies being originated in the early 2000s. And what they don't know is why very wealthy, very senior individuals want to sell their policies. And on the other end, from an investor base, how this becomes a truly uncorrelated asset class that can be a portion of your portfolio. Fixed income-like volatility, but equity-like returns. And we have about an 8-year track record to show that. So I'll just give you a few points about that. When you look at the overall market, there's about $20 trillion in life insurance, 900 million lapses annually. Now, a lot of the folks that sell us their policies bought universal life insurance in the 80s and 90s for estate tax purposes. I believe back then the estate tax exemption was around $1.2 million for a couple. So it made sense. Overfund early, you're not gouged by Uncle Sam, transfer that wealth to your heirs whenever you pass away. But a few things happened. Number one, they outlived their life expectancy, given the wealth effect. If you are in the wealthier cohort, you should take better care of yourself. You have access to doctors and good food and exercise. So their life expectancy might have been 78. They wake up at 88 and realize they feel good. They're still going strong. So they do not need this policy. Their kids are already in their 50s. Second, estate tax exemption doubled, and as of about a few weeks ago, it's doubled again. So they don't need it for estate tax purposes. So instead of hanging on to this policy and paying extreme premiums, they can sell it to us, and we pay about 10 to 12 times cash surrender value. Now, something that's staggering to me is the fact that roughly 90% of individuals with universal life insurance never actually get to a death benefit. It's lapsed. The winner in that is the insurance company. They were able to get you to pay in for 2 decades, and you never actually use it. So the winner is the insured, the winner are our investors, and insurance companies make plenty of money, so we feel like they're going to be just fine if we take a small portion of those assets. The way that we bundle these policies together is in an evergreen, open-ended hedge fund. Our fund is called the Vita Longevity Fund. It was named by Barron's as one of the top 100 hedge funds of 2016, but I don't usually call it a hedge fund because I think that can be misleading. Basically, you have a pool of over 1,300 policies, short duration assets, average durations around 3 years on the portfolio, AA corporate credit when you look at the underlying insurers. So think of it like a bond portfolio of these short duration assets. Because there are not a lot of folks buying policies, it's a highly regulated industry, it's complex, takes an entire enormous servicing team to handle that. There are not a lot of folks buying them, and we can buy the assets extremely cheap. So over the last 7.5, almost 8 years, our fund has returned, you look net lifetime, about 11.5%. So when you compare that to the S&P 500, could be similar returns, but very low volatility. You see a lot of numbers up there. I think the big takeaway, we've had 4 negative months in about 8 years. It's not something that's too good to be true. If you have a portfolio of folks in their late 80s and early 90s, they will eventually pass away. You receive death benefits. That generates the return. So it does make sense that once you have a large enough diversified portfolio, you have consistent outcomes. If you only have one life insurance policy, you're making a bet. If you have 5, the standard deviation is going to be pretty broad, but once you have 1,000, 1,500 policies, there's a high degree of probability of what your cash flows look like. So we would like to bore you with our return profile, but more importantly, this could be a portion of a portfolio that has nothing to do with the stock market or with bonds. If interest rates go up, that has nothing to do with the pricing when we buy a life insurance policy. The pricing has to do with the new life expectancy report. If I go take out insurance, they're going to ask, do I smoke, do I drink, do I exercise, what's my cholesterol, and my premiums are adjusted accordingly. We get underwriting when we buy a policy. So that's the arbitrage. Insurance companies can't re-underwrite 85-year-olds. We get to see their medical data, get to see that new survival curve, and assess the risk accordingly. So given that type of profile, we have very steady returns. We're not going to hit 25s, but it's very statistically difficult to hit a 5 either. This is just a definition of a life settlement, very simplistic. In 1911, the Supreme Court said your insurance policy is property. You can donate that to a church, give it to your college, save it for your heirs, but you can also sell it, just like you sell a house or a watch. So since then, as part of your property, you have the ability to do so. But as I mentioned, in a very good way today, it's highly regulated. This just shows the benefits to the seller of their policies. We pay 10 to 12 times more than their cash surrender value, and most folks lapse their policy anyway. If you look at the investor benefits, it's really Vita Capital here in Austin, Texas, Apollo, Blackstone, Berkshire Hathaway. These are the players in the space. I mean, it is not broadly used because there's some complexities about the actuarial science and the underwriting. As I mentioned, there are 60 of us that are downtown in an office, and it takes an entire team of attorneys, folks on the servicing side, to manage a portfolio of these policies. So you don't see a lot of people in the space. We're buying these policies at a gross rate of return of 16. If this was a corporate bond portfolio, 3-year duration, AA average credit quality, we'd maybe be hitting 6s. So to get a 16% return, it's irrationally cheap. But that's great for our investors. They're not complaining about that. This is how the pendulum has swung. From a complete lack of regulation, even a decade, 15 years ago, it was the Wild West days. Anyone could approach you to try to buy your policy or help you sell a policy, and they could take egregious commissions. No fee transparency, no protection for the insured. So that negative stigma, rightfully so, from the lack of regulation 15 years ago. Today, the transaction is like if you're buying a mortgage for a house. Highly regulated, a lot of paperwork, a lot of oversight, and we don't look at policies until a family comes to us. So every beneficiary has already signed off. They've realized this is a good financial decision, and they're simply wanting to know what would we pay for it. We own our own life settlement provider, which is unique. You might look at this and say, okay, it's a math equation. It's actuarial science and the law of large numbers. I get it. Well, why can't I go start my own firm? Why are there not more people in this space? If you're outsourcing the origination, buying the policies, how do you know that who's purchasing the policy has your incentive at heart to make sure they're assessing the risk appropriately? Are you sure that the attorneys doing the due diligence are making sure that there is no stranger originated life insurance? Can you be sure on the back end, insurance companies receive the premiums? Who does that? There have been firms that have tried this in the past, and through outsourcing and not having that alignment of interests, it hasn't worked. So we are fully vertically integrated. We do everything in-house. So we eat our own cooking. The policy we buy either haunts us or helps our investor base, and we're the only firm that has a provision. If there's ever a policy contested, the GP will take it on the chin. We will buy that policy out of the fund at the most recent month's NAV. In over 7 years, we've never had a policy rescinded for fraud. We are very careful and diligent about what we buy. So this is just the fund itself. Usually the way to access this asset class is through a closed-end private equity vehicle. So minimums might be $5 million plus. You're locked in 8 to 10 years. What's unique is we have an open-ended hedge fund where the minimum's as low as $250,000 and the lock is as short as 2 years. And you can take quarterly cash flow. So we have, 75% of our investor base in this fund are accredited investors through very good, large, established RIAs. But we also have state public pensions that have written checks $1 to $200 million. We have a health system coming in next month, many endowments and foundations. So a growing investor base that sees this actually in their fixed income bucket, not the equity or alternative bucket. But clearly that would be up to your advisor to decide, but it is a growing, more accepted asset class. And we have stellar service providers. Our investor base expects the best. So I think, when you look at the entire firm as a whole, the experience for our investors, it's a good way to access this asset class without having to dedicate $25 million to Apollo for it to be locked up for a decade. So once again, that is unique with our firm. Can I take any questions about maybe the asset class itself, the fund, what it is that we do? Yes.
How do you find the sellers?
There are two markets. So if I go take out insurance, that's primary insurance. If I want to sell that in 20 years, that's the secondary regulated market. So that is one market we're in. There are life settlement brokers that specialize in this space. They market to insurance agents, estate tax attorneys, CPAs, and RIAs to say, you stumble across someone in their late 80s with a UL policy and they don't need it, give me a call. I'll package it together and we'll sell it to Coventry, or we'll show it to Coventry, Magna, a few firms, and see what price we get. So 90% of our flow in the regulated market comes from these specialists that are across the United States. We also have insurance agents call us directly. We'll have estate tax attorneys that come across this, and I think, given the new tax changes, it will pick up dramatically. The other market is called the tertiary market. That means it's a policy that's already been sold. So we bought a pool of policies from the Dow Chemical Pension Plan. They had it as part of their retirement benefit package, but they're merging with DuPont. They no longer needed it. The CIO said, sell non-core parts of this business. So we bought the portfolio from them. We've bought portfolios from Royal Bank of Scotland, AIG, Credit Suisse, Deutsche Bank. So there are a lot of institutional investors that we also buy pools from. So those are the two markets. But it's interesting. They come to us. You won't see ads on TV from our firm. And when you think about the folks we're buying policies from, they have a financial team around them. So we're not looking for someone with a $50,000 term life insurance policy. Any other questions? Well, if you need any follow-up, we have a lot of material. I tried to very much oversimplify that just to give you a taste of what this asset class looks like. But I think, given the market environment, when people want something that's not just correlated on the upside, but on the downside, it gives them a lot of comfort to know it's a different animal. It's a little esoteric, a little outside the box, and that's what investors tend to be looking for. But yeah, if there's any questions, Mark knows how to get a hold of us.
Very good. Thank you, Ann. Appreciate you.
You are
Thanks,
welcome.
Ann. Really appreciate you.
Of course.
Very good. Awesome. Okay, hey, that's what we got for you today. Really appreciate the time. Couple things. Really want to thank Black Creek Group for being here. Thank you all very much and for hosting our lunch. Really appreciate that. Great content as well. I know our First Trust team, they had to run off to another venue, but we really appreciate them as well. And then Ann sharing some great knowledge. On behalf of our Eltekon team, Brent, Lewis, Lisa, myself, we really appreciate you being here. We know your time is valuable, so thanks for spending it with us today.